So let's start with this session, which is more on the accounting and the taxation part of the interest rate derivative. So in this chapter, we'll see the overall segregation of the accounting treatment for different entity types and different transaction types, as well as what are the taxation applicable and what is the tax treatment for interest rate derivatives. So what are the accounting guidelines? So the accounting standards Index 109 and Accounting Standard 30 provide a detailed guidance and recognition. From an exam perspective, you have to remember these sections: Accounting Standards 109 and Accounting Standard 30, which requires disclosure of financial instruments, including derivatives. And as we saw in the last chapter, that disclosure is mandatory for any entity who is involved in interest rate derivatives in India. Disclosure is mandatory, along with why have they entered, whether it's for hedging or it is for speculation or something like that. And what is a fair value measurement? So what is fair value measurement? So in the financial statements, there are two statements. One is the balance sheet and one is the income statement or the P&L statement. So fair value measurement means whatever is the MTM gain loss, whatever is the mark to market gain loss has to go to the P&L as profit or loss. So it cannot be a balance sheet item. It has to be recognized on profit or loss basis. So we will see that in detail in the subsequent slides. So what are the recommended recognition and measurement principles? Initial recognition: derivatives are recognized on the balance sheet at fair value on the trade date. So if I entered into, say, 10 million exposure and the current value is 11 million, or the current value is 9 million, this has to be shown on the balance sheet. And whatever is the difference, 11 minus 10 or 10 minus 9, that 1 million profit or loss has to go through the P&L. And the balance sheet should be at the fair value. That means whatever is the current value. Subsequent measurement, that is after it has been bought, it should go through the FPTPL. Again, as I mentioned, FPTPL is nothing but income statement or P&L statement. Here there will be a head known as gain and loss from interest rate derivatives. So whatever is the gain loss, suppose there is the current value is 9 million and the initial value was 10 million. So the current loss is 1 million. Suppose the current valuation is 11 million, then the current profit is 1 million. So whatever is the gain loss, it has to go through the P&L and it should be reflected in the P&L. The fair value is determined by the MTM, because for derivatives, the daily market prices are coming in of the underlying and the contract value, whether it's futures or options. The exchange is providing the end of day price. The end of day price is used for the mark to market calculation. And as we have already seen, that interest rate derivatives are daily mark to market and the settlement is done on T+1 basis. So whatever is the profit and loss has to be settled on a T+1 basis for interest rate derivative contracts. Then we come to the hedge accounting framework. What is hedge? We have seen that derivative position, if they have any interest rate exposure, suppose someone has a 100 million fixed income portfolio and the average yield is 7%. Now they want to hedge this, so they will enter into interest rate derivative, so that if there is any mark to market loss over year in the fixed income portfolio, they will hedge it using interest rate derivatives. We have seen that there are a lot of instruments that can be used. You can use a forward rate agreement, you can use futures, you can use options. So there are multiple instruments that can be used to hedge. So first is the hedge designation. Organization must formally designate and document hedging relationships at inception, identifying the hedged item, hedging instrument, and nature of risk, and the effectiveness assessment method. That means whenever I am doing a hedging of any exposure, I should be declaring why I am doing the hedge, what risk I am trying to cover, and what is the effectiveness of the hedge. So this is required as a disclosure for regulatory purposes. Second is the effectiveness testing. Suppose I did a hedge over here of 7% for my 7% YTM portfolio, and the hedge is not working. Even after hedging, my portfolio is in loss, or it is the losses are higher than the anticipated loss. That means my hedge is not effective. So hedges must be highly effective both prospectively and retrospectively. Retrospectively means past. Prospectively means future. It is used regularly assessed using the quantitative methods to hedge offset 80 to 125% of hedge risk changes. That means your hedge effectiveness should be at least 80% to 125% of the range of your portfolio exposure. So at least that should be your effective hedge. Then what is accounting treatment? For qualifying hedges, gains and losses on hedging instrument may be deferred in other comprehensive income rather than immediately recognizing profit and loss during earning volatility. What they are doing is, suppose I am doing a hedge, the gains and losses on hedging instruments, may be deferred in other comprehensive income. What is OCI? So you have balance sheet. Balance sheet has two legs: asset, liability plus equity. This is your balance sheet. Your balance sheet is like this: asset on the left hand side, liability plus equity on the other side. So OCI is basically accumulated earnings and losses. What happens when you pass it in the balance sheet? The volatility of the P&L moves away, because suppose if you are showing the P&L on the hedged instrument, I'm not talking about the interest rate derivatives, on the hedged instrument, the P&L, if you pass it through the P&L, your profit and loss will be volatile, because every time you're firing the P&L, it will show either profit or loss, But once it is part of the OCI, which is the equity part of the balance sheet, it will be shown as a single amount and an accumulated earnings and losses. What is discontinuation? When hedges no longer meet effectiveness, that means your hedge is not effective. Whatever you have entered into, your FRA, your futures or options, is not providing the hedge or not mitigating the risk, then it should be discontinued and hedge accounting ceases. No more hedge accounting principles will be applied if the hedge accounting is not effective. So we will see this in detail. We will understand it with an example also. So this is the types of hedge accounting. This is the actual details of the hedge accounting. First is a fair value hedge. Now from the word you can make out fair value means, if it is fair value, that means the recognition of MTM should happen. Whatever is the losses or whatever is the profit should be recognized. So hedges exposure to changes in fair value of recognized assets and liabilities, both hedging instrument and the hedged item. Hedged item means underlying instrument. Suppose it's a fixed income bond, are recognized in profit or loss, offsetting each other. Fair value hedge will go through P&L. Cash flow hedge will go through the balance sheet, because here it goes through the OCI. Similarly, net investment hedge will go through the OCI balance sheet. So let's understand what is the difference. So for fair value hedge, MTM should be recognized and it should go through the P&L. It is used for fixed rate debt instruments, protects against interest rate movements, and reduces balance sheet volatility. That means for any fair value hedge, the mark to market has to go through the P&L, and it is for both the instruments which is being hedged and the hedging instrument. Hedging instrument here could be FRA or futures. Since both are going through P&L, the profit for this will be loss for this, and the loss for this will be profit for this, because it is a hedge instrument, so it will be on the opposite side. Let's understand again. If I am hedging a fixed income bond at say 7%, this is my asset And suppose I'm hedging it, that means I'm taking an opposite position, hedge. If I'm recognizing the gains and losses of one in P&L and the gain of losses of hedge again in the P&L, they will offset each other because gain of one party is loss for another transaction because they are opposite direction. So it reduces the balance sheet volatility because it gets offset. Second is the cash flow hedge. Hedges exposure to variability in cash flows from recognized asset and liabilities of highly probable forecasted transaction. Effective portion of gain losses deferred in OCI until hedge transaction affects profit or loss. This is common for floating rate borrowings. Floating rate borrowings means it could be MIBOR linked, or it could be interbank rate linked, or it could be repo linked. Stabilizes future cash flow, reduces earning volatility. Why? What they are saying over here is any cash flow which is hedged, that effective portion of that gain loss is deferred into OCI and not into the P&L. OCI means balance sheet. Wherever you see OCI means balance sheet. Full form is other comprehensive income, and it is part of the equity part of the balance sheet. So cash flow hedge goes through the balance sheet, fair value hedge goes through the P&L, net investment will also go through the balance sheet. Hedges foreign currency exposure of net investments in foreign operations. So net investment hedge will be used only for foreign currency exposure. Treated similar to cash flow hedges with effective portion recognized in OCI. This is used mainly for foreign subsidiary investments. Currency translation risk. Currency translation means USD INR when at the start was 90, now USD INR is 92. So it is loss for the Indian subsidiary and profit for the foreign subsidiary. So this is the currency translation, that is conversion. And it differs the exchange rate differences. Why? Because it is going in OCI. Let's understand that how your balance sheet and P&Ls are structured. To understand how they are structured, let's see an example that you have a balance sheet. A balance sheet will have three components: asset, liability, and equity. So the formula for balance means both have to be equal. So asset is equal to liability plus equity. Then only the balance sheet will be balanced. So what they are saying is cash flow hedge and net investment hedge will impact this part of the balance sheet, whereas fair value hedge will be part of the P&L statement where my income and expenses are managed. So P&L will have income, expenses, balance sheet will have asset and liability plus equity. Equity is known as OCI, equity accumulated earnings and losses. Then what are the financial statement disclosures? Nature and event of risk arising from derivatives like interest rate risk. What are the risk management objectives and policies in place? What is the quantitative data about the risk? Like quantitative data could be duration impact, PV01. PV01 means price changes in price for 1 basis point change. PV01 means price value change because of 1 basis point change in the overall portfolio. So that is also a quantitative number. Fair value of derivative instruments. Gain or losses are recognized during the period, which is P&L. Hedging relationship and their effectiveness. Notional amounts of outstanding contracts. Why notional amounts is written, not the actual amount? Because in derivatives, most of the transactions will happen on cash settlement basis. That means it will not be delivered. So whatever is the MTM, that will be going through the P&L, and the notional amounts have to be declared as part of the outstanding contract. Presentation requirements. Derivatives are presented separately on the balance sheet. Why it is separated as a balance sheet? Because derivative income is treated as business income, and derivative transaction itself is to hedge or to speculate. So it is treated separately from the different assets. Assets and liabilities from different counterparties cannot be offset unless legal right exists and intention to settle net. That means suppose I have 5 exposures against 5 different counterparties. One could be against Reliance, one could be against Tata, something like that. I have 5 different exposures. I cannot net my liabilities against each unless there is a right to do a net settlement. If I have exposures across 5 secured issuers, I should be reporting all of them. An income statement presentation distinguishes between the hedged and the unhedged part of the derivative portfolio. Income statement means P&L statement wherein the income and expenses are laid down. Now from the accounting we'll shift to the taxation, how the interest rate derivatives are taxed. Profits and gains from trading in interest rate derivatives are taxable as business income. As I mentioned in the previous slide, business income comes under business income. Any one of you who is doing F&O and they're submitting their taxes and filing will know that income from derivatives will come under business income. Tax treatment depends on whether the transaction is speculative or non-speculative. Non-speculative will be mostly for hedging only, because speculative is where you don't have an underlying, you might still get into a derivative, but non-speculative would be for hedging. Business versus speculative. Exchange traded derivatives settled through recognized clearing corporation are treated as non-speculative business income. This classification allows setup of losses against other business income. Suppose a person who is running an NBFC is running an NBFC, and in the NBFC business he has a 1 million profit example, and within that same entity he is also entering into derivative contract to hedge, right? And in the derivative contract he has a say 500,000 loss. So the profit from business can be set off against the loss from the derivative if it is a non-speculative transaction. Why it can be set off? Because it is treated as a business income. Since it is treated as a business income, the profit from business can be set off against the loss from the derivative portfolio. For tax purposes, there is no STCG or LTCG. Why? Because it comes under business income. So no STCG and LTCG. So these are the important parts from the exam perspective. Don't get into the calculation and balance sheet treatment and other things. You just have to understand how these derivatives are taxed and how are they accounted. So from an accounting perspective, just understand if it is fair value, it will go through the P&L. If it is cash flow hedge, it will go through the balance sheet. So this is the important part to understand, not actual tax, accounting and other things. That is not the scope of the exam as of now. Tax rate, 30% corporate tax rate. Domestic companies pay tax on derivative income at applicable corporate tax rate plus surcharge and cess, which is very common in all tax payments. Effective rate based on company's total income and applicable tax regime. Now it also depends whether the company is tax exempt or taxable. If it's a tax exempt company, they might not pay taxes. If it's a taxable company, whatever is their applicable rate, they will be paying it. Why? Because this again comes under the business income. 42.75 roughly is the highest marginal tax rate that it can go. Highest tax rate including surcharge and health and education cess for companies with income exceeding specific threshold. Suppose someone has 50 crores of profit, they will fall under this bucket because there is a threshold for the business income, or someone has 500 crores of profit, they'll fall under this business. So if your profits are exceeding the specified threshold, the maximum tax rate that can be applied is 42.75%. Alternate minimum tax, companies claiming certain deductions may be subject to AMT at 15% plus surcharge and cess. Why? As I mentioned, there could be entities which could be tax exempt, taxable, or there could be less tax companies. It could be MSME or some other kind of categories. We should not get into the detail of what kind of companies it will be. But these are the three different types of taxes that are applicable. Highest tax is 42.75, corporate tax rate, and the applicable tax rate. Applicable tax rate means if it's a tax exempt, there will be no tax. If it's a taxable entity, they will be taxed at their current tax rate. Individual taxpayers like us are taxed at a slab rate applicable to their total income. So whatever is your income tax based tax bracket, you will be charged on that, and again it is treated as business income. STT is not applicable in interest rate derivatives unlike equity derivatives. Very important. No STT. Then what is the loss set of criteria and carry forward provisions? Carry forward provisions in the taxation part. Let's understand. Non-speculative business loss. That means hedging mostly. Losses from exchange rate interest can be set off against. If I have a loss, say, let's take an example, I have a 10 million loss in my derivative portfolio. I can set off this loss against any income from business or profession in the same year. So if I can set it off against my salary, my own business income, so my tax liability reduces because the profit that I was having here, the tax on that will be reduced by the extent of loss over here. Income from house and property, that would be rent. Carry forward for 8 assessment years. Set off business against business income in subsequent years. That means 8 assessment years means losses can be carried forward to 8 years. So if I have a loss in 1 year, say I had a loss in FY 2019 and I have a profit in FY 2024, which is 5 years, the loss in this year can be set off against profit in this year. There is the 8-year carry forward provision. And these are the documentation requirements. This is very self-explanatory. What are the contract notes and stockbrokers? It obviously comes in your email on daily basis whenever you are doing the trading. Daily trade confirmations, again, this comes from the exchange in your email. Mark-to-market statement comes in as part of the mark-to-market margin calculation as on daily basis from your broker and exchange. Settlement statements from clearing corporation. Again, this will be provided by a broker. Bank statement showing fund transfer. This is when you have funded your account. So whenever you are funding your broker account from your own bank account, those transactions are required. And computation of profit and losses. Now this again, your broker provides a capital gain statement for equity and business income statement for derivative. So any broker will provide these two, or your own CA or your accounting firm can also do this. Now why this is required? Because if there is any tax audit by the authorities, so you should have all these contracts as the proof and all these papers as proof that what was your transaction type and why have you done all this coverage of losses. TDS provisions in derivatives, broker payments, no TDS is applicable. Now these part are important from exam perspective. No TDS for brokers for derivative transaction in IRD. This simplifies cash flow management for traders and investors. Why? Because if you have paid 100 rupees, your final settlement amount is also 100 rupees. There is no TDS which is deducted. Easier to manage and settle. Settlement payments received from CCIL or clearing corporations are not subject to TDS. Again, this is not subject to TDS. Why? Again, because this is going under business income. So whatever is the applicable tax rate, you will have to pay at that tax rate. Interest income, interest earned on margin deposit with brokers may be subject to TDS. Now suppose you have a $1 million outstanding with any broker XYZ. Now this position that you had is in profit and your current profit is say 50k, right? Now this 50k you are not using and you are leaving it with the broker. This 50k is available for the broker in his pool. He might use this cash or he might show it as part of his cash deposits. So he will pay you interest on this. Interest earned on margin deposits will be subject to TDS under section 194A and above this threshold. So these are important parts for exam. Under which section, what type of tax, what is the threshold. It's an important note written. While TDS may not apply to derivative settlement, taxpayers remain responsible for computing and paying the business income under section 23, 234B and 234C. Again, this is important from exam perspective. What are the sections under which you have to pay the income taxes? Now we have the GST. Brokerage and transaction charges levied by stockbrokers are subject to 18% input tax credit GST. Fair and square, we know what is GST. Transaction charges, now this is for the broker, this is for your exchanges, NSE and BSE. Transaction charges, clearing charges and other fees levied by stock exchanges again attracted 18% GST. What are the exemptions? The actual derivative contract itself is exempt from GST as it is considered supply of securities. Only ancillary services attract GST. So no GST on purchase and sale amount. It's only on the services like broker and exchanges. Finally, what are the key takeaways? Now understand this chapter was a short chapter, but it is giving you an indication of what is the accounting treatment required for legal reporting and as well as what is the taxation implication. So whenever as mutual fund distributors you come across these type of funds in SIF where they are indulged in interest rate derivatives, so you will be aware of what would be the taxation applicable to the fund itself and what is the accounting treatment that is required. So you will have an extra edge over other distributors in understanding what could be the probable taxation to the fund itself, right? To the SIF, which is entering into interest rate derivatives. So what are the key takeaways? We have a comprehensive framework. Accounting standards are laid down. Measurement policies are laid down. We saw P&L and OCI. P&L means income statement. OCI means balance sheet. Hedge accounting benefits. Qualifying hedge relationship allowed deferral of gain losses in OCI. OCI again is balance sheet, which reduces volatility. Why? Because it is not going through income statement, so your profit and loss is looking stable. However, accumulated earnings and losses are going into the OCI. Exchange traded are treated as non-speculative hedge and under business income, allowing loss to set off against business income for 8 years. This is important from exam perspective. Losses can be carried forward for 8 years. Maintaining detailed documentation, proper accounting records, and audit documents is essential for derivative transactions, because if there is any scrutiny or any tax audit which is done on the individual or on the company, these kind of contract notes, the settlement notes, the fund transfer proof, and all those things will be important from an audit perspective. So net, this was the overall chapter. It is a self-study chapter, more or less. The reason which why we have created this video specifically on the accounting and taxation part is to make you understand that taxation is different in derivatives, especially it comes under business income. And accounting treatment, though not relevant as such, it will be more relevant for the AMCs to look into this. But from a overall knowledge perspective, just understand under which section this reporting has to be done. So with this, we end this chapter. I'll see you in the last chapter in the next session. Thank you.
Yeah, so let's go across each question. So the first one is guidance notes on accounting is recognized for what hedge accounting? So the correct answer is all of the above. We have three models: fair value, cash flow hedge, and the foreign operations. This the second one most of you have got incorrect. The answer is IAS 109. That is the section against which the accounting of derivatives guidelines are provided. Third one, most of you guys have got corrected. That is the income from derivatives treated as business income. Fourth one, again, most of you guys have got it correct. It cannot be the salary income cannot be included in the business income. But if it's a salary income from other than your current salary, if it's a consultant based work, or if you're any other work, that can be charged as business income. But the core salary cannot be treated. And the last one is loss on derivative can be forward up to 8 years. So any loss that has happened in the last 8 financial years can be carried forward against any profit. So with this, we end this chapter. It was a short chapter. We'll see you in the last chapter tomorrow, which is the code of conduct. Thank you guys for joining.